One of Donald Trump's top economic advisors just came out and said that we are 100% guaranteed not to have a recession.
Kevin, real quick, are you expecting a recession this year?
100% not.
So is he right or is he wrong? I'm going to do my very best to answer that question for you in 3 simple, fast steps. Step number 1, let's go over WTF has been happening in the S&P 500. We go to April 15th, 16th today. We go all the way back to March 17th. On the left, we go from 51.54 on the S&P 500 up to 57.98. You can see back in March, kind of whistling along here, nothing really happening, kind of going up in a little trend here. We're all pretty bullish. The economy is looking pretty darn good. And then we start, well, maybe the tariffs are going to impact the economy. Then we get to Liberation Day, and it's boo, Wile E. Coyote. But since that time, we have had massive volatility. Why? Because it's really revolving around the tariffs. Now, the volatility, I'm not saying the economy. We'll have to discuss that in more detail throughout the rest of this video. But this big move down is because the tariffs were a lot bigger than expected. And then we get this, oh, just joking, we're going to pull back some of the tariffs or do a 90-day freeze, and stock market rips higher. And then it's like, yeah, well, that uncertainty is still in the market, so then the market tanks. Then we get Trump coming out and saying, yes, we are going to pause 90 days. The market goes up by the highest amount we've ever seen in human history, at least on the NASDAQ. And then we get more uncertainty. So we're just going back and forth in this game of ping pong based on what is happening in the headlines with the Trump tariffs. So the mainstream narrative out there was the economy was humming along, doing pretty darn good. And then we had Donald Trump come in with his tariffs that surprised everyone and created all of this uncertainty. So stock market plummets and recession odds skyrocket. But you'll notice this mainstream narrative pretty much revolves exclusively around tariffs. And I think this is incorrect. Step number 2. So now let's go over the data to determine if we are 100% not having a recession, assuming that Trump continues to roll back some of these tariffs. So let's start by going over the University of Michigan surveys of consumers. Now, a lot of you point out that this is politically skewed, and you're right when it comes to inflation, but not so much when we look at other things in the economy that this survey picks up. So check this out. Consumer sentiment fell for the 4th straight month, plunging 11% from March. This decline was, like last month's, pervasive and unanimous across age, income, education, geographic region, and political affiliation. So it is true that the Democrats are expecting more inflation than the Republicans, but now they're both expecting inflation, and regardless of your political affiliation, geographic region, etc., you think the job market or the labor market is softening to a degree to which is very concerning. Now let's go over the Empire State Manufacturing Survey just out today and look at this red line. So the red line is the expected, the blue line is the current. So the current conditions aren't great at a negative 8.1%, but look at that red line. This is the expected. Currently, we are at a negative 7.4%. Now let's go down to the summary to see what the New York Fed themselves are saying about the data. Firms turned pessimistic about the outlook, with the Future General Business Conditions Index falling to its second lowest reading in the more than 20-year history of the survey. So let's go right back to the chart and focus on this red line once again. And at negative 7.4%, as far as what is expected, you go back to the cerveza sickness, and we weren't even close. In fact, we weren't even negative. You go back to the GFC, and we were just slightly negative at negative 5.1%. But you go back to 9/11, and that's the only time in the last, call it 25 years, that the expectations for general business conditions were lower than they are right now. And just to make sure we're all on the same page, it's currently lower than it was during the cerveza sickness and during the depths of the GFC. And this is from Bloomberg talking about the S&P 500 earnings revisions, saying they are the worst we've seen since the cerveza sickness. An update on just how bad U.S. earnings revisions have been, thanks to some new data from Bloomberg, worst since April 2020 to be specific. And you can see this green line. Now, to be clear, it was really bad October 22, but the stock market was going down significantly then. And it's even worse now. The good news is we're only at a negative 48%. When during the cerveza sickness we got down to a negative 81%. But you can see the trend is not looking good. And let's shoot over to the Atlanta Fed. They have their GDP Now calculator, and this is an estimate for Q1 real GDP. And we can see that it is negative, call it 2.3%. Now, it is true that one of the reasons this is so steeply negative is because we have this big trade deficit, or a big part of the trade deficit is people bringing back gold into the United States because they don't want to have it tariffed. They want to try to get that gold back before these tariffs go into place. But even when you adjust for the amount of gold that is coming back in, the GDP Now forecast is still negative. In other words, an economic contraction in Q1 of 2025. And let's shoot straight over to the good old reliable yield curve, 2s and 10s. We were massively inverted, as most of you know from watching my videos, but look, we are now uninverted and the curve is steepening out. And this would normally be good news, but if you go back to pretty much every recession that we've had, let's say in the last 30, 40 years, you can see that when the stuff hits the fan is not when the curve is inverted, but when it actually uninverts and starts to steepen, and that's usually as a result of the Fed dropping rates. And we can see the exact same thing playing out right now. Does this mean that there's a 100% certainty we do have a recession? Absolutely not. Because regardless of what the Trump administration says, there are no certainties. There are only probabilities. But we have to look at all of the data, and then we have to come to our own conclusion as to what the probabilities are that we avoid a recession, even if Trump continues to pull back on these tariffs. Step number 3. So we know there's not a 100% probability that we avoid a recession, and there's not a 100% probability that we go into a recession. So what economic indicators should you be watching to determine what will happen next? Or maybe better said, when will the stuff hit the fan? Or will it hit the fan at all? You guys know from watching my videos, we talk about the yield curve all the time. We talked about that in step number 2, when it uninverts. But a better mechanism for timing is something like credit spreads. We've been talking about that a lot on these videos lately, and those credit spreads have been blowing out. Now, they're not that high, and they have been coming down more recently, but this is definitely something to watch. Also, the unemployment rate. You guys know about the SOM rule, and when we usually see the unemployment rate spike, that tells us that the recession isn't coming, but it's already here. But we can really get more specific about the labor market. And this is really the key. That's one of the reasons why I went over that University of Michigan survey in step number 2 that admittedly is biased. That's for sure. But I wanted to point out the fact that when you look at the labor market component of the University of Michigan survey, it's pretty much unanimous across the board. Republicans, Democrats, Independents, They all see storm clouds on the horizon. So let's look at the initial claims. The Federal Reserve themselves actually came out with a paper recently talking about how this is a good economic indicator. So this chart goes all the way back to 1958 to today's date. Now, editor, you'll have to help me out with the chart because the original looks a little bit different than this. But what I wanted to focus on specifically is the actual initial claims. And this red line, according to the Fed survey, is kind of the threshold to determine whether there's a very high probability that you're in a recession, or I prefer stuff hitting the fan, or there's a very low probability. And what's important here with this chart is not just this red line, but if you look at it, it's really what direction is the black line going. So again, just to make sure we're all on the same page, this black line represents initial claims. Okay? Red line represents the threshold set by the Fed as to when the stuff is hitting the fan, when it's not hitting the fan. But what I think we should do is analyze it a little bit further and say, okay, what's the trend doing? So going back to 1958, you see that we almost got up to this magical 400 mark. But in the recession of the early 1970s, we go above, definitely had it. In the recession of the early 80s, and then same thing, early 90s, .com, GFC, as you would expect, the cerveza sickness. But look where we are here. We're not even close. In fact, the trend isn't even up. So if you had to ask me my base case, it is that the United States will go into a recession as determined by 2 negative quarters of real GDP in 2025. But that's not to say that we are in a recession right now. Because if you look at the labor market through the lens of initial claims, it's still very low, and we haven't seen this start to trend up. And this, I think, is the key. So if I had to focus on one economic indicator to determine where we are in the cycle, this one would definitely be it. So did Donald Trump just cancel the recession? I doubt it. But you'll know whether I'm right or wrong by simply paying attention to the labor market.